Would you agree with Michael Lewis's characterization that the stock market is rigged? I know you've described it in the past as unfair, but there's a difference between unfair and rigged.
Yeah, I think I probably would not be quite as hyperbolic as that, but we have started actually over a year ago looking at the use of information that didn't fit into traditional categories of insider trading, but because of the presence of these algorithmic high-frequency computers, they could use information that before was really useless. And we obtained a settlement with Thomson Reuters was the best example, because we learned that in addition to releasing this information to their customers at a particular time, they gave a 2-second edge to a select group of higher-paying customers, which would have been irrelevant 10 or 15 years ago, but in the universe of high-frequency trading and multiple exchanges that are interlinked becomes a problem. They, to their credit, agreed to stop giving the 2-second edge, but we're looking at whether there is any other illegality. High-frequency trading of securities, good, produces liquidity. Front-running the market, bad.
Do you believe that there is illegality?
That's why we're conducting an investigation. We're looking into that.
Well, then, is the one at fault really the regulators, the SEC? Because the SEC has conducted a number of studies over the last few years and haven't concluded that there's any wrongdoing here. So couldn't this be a case of hate the game, not the player?
No, I think that the game has gotten very complicated. The SEC is looking at this, and I've been in touch with the SEC. Commissioner spoke up last week, I think fairly forcefully about it. They need to make moves in the change the regulatory structure. But look, we now have a situation with more than 60 private and public exchanges that are interlinked, and there are cracks in that system. And the high-frequency traders in this race for speed try to use the milliseconds of advantage they have over other traders to front-run markets and to take advantage of the cracks in the system. The SEC's got to look at some re-regulation, in my view. But I think there are other things that can be done in the meantime. The idea of putting some speed bumps in, and there are a variety of ways to do this, just to slow the process down or to take away the arms race, the need to take chances for ever greater speed, which also could have a destabilizing.
But it was the SEC that created Reg NMS, so they created this system that has the cracks in it. When I look back and I look at the way specialists operated, they had way more control. They knew so much information and could control bid-ask. I mean, now it almost seems like it's more fair than it was 15 years ago.
No, I don't think so. I mean, I do think that it's important to distinguish between high-frequency trading, which is a good thing. Extra liquidity compresses the bid-ask range, and the fact that there are those folks who are trying to take advantage of things to front-run the system. If you can get information, and Michael Lewis talks about this, that someone's dumping a lot of, I think he used Microsoft as an example, and you have the ability to know that just a few seconds before people can execute the trades, not even seconds, milliseconds. The other piece of this that we have to look at is the race for speed is inherently dangerous, because that leads people to take more and more chances to try and get an advantage, and that could lead to destabilization of the markets.
Is it, though, Mr. Attorney General, you describe it as an arms race, is it by definition dangerous? And I ask this question only because in just about every other industry in America, we celebrate technological advance. We celebrate the use of technology to solve problems, to build better mousetraps, except, it would seem, in the equity capital market. Lewis himself says that from his perspective, now he's not an attorney general of the great state of New York, but he says from what he can tell it's legal.
Well, I think he's probably referring to federal law. We have a different securities law here. We're looking at it. We're not prejudging the situation, but I think your point on regulation is a little bit off, and we tend in New York to be a little bit market-centric and finance-centric. We celebrate technology, but we have speed limits and airbags. I mean, we celebrate technology, but we have systems so that you can cancel your credit card if it's stolen. So there are ways to have checks and balances, and what is being proposed is in the way of speed bumps, and this is something, a new conversation. I support this idea of frequent batch auction. So you would have all the trades that are up for 1 second or 1/2 second, and then it's allocated by price, not who got in a few milliseconds before the other at a lower price. That's one way to do it. There's another way with this new exchange that was featured in the 60 Minutes program, IEX. They have their own way of putting in a speed bump. This is a conversation that's just beginning, but I think it's very important both to prevent front running and to ensure that the markets are safe. Look, the problem here is, and I'm a fan of the markets, but I think Michael is right. We've lost a lot of credibility. A lot of investors do not have confidence in the markets, and it's up to those of us who believe in them who enforce the law and regulate them to restore that confidence.
Have the regulators lost a lot of credibility? The regulators might have egg on their face right now. I mean, you really are speaking about this with great expertise. Should you be the person stepping in here, are you making the regulators look like a fool? Is Michael Lewis making them look like a fool?
No, I don't. I hope not. That's certainly not our intention. These are changes in the structure. I have been in touch with the SEC. They're taking a hard look at it. Then there are other regulators out there. But let's keep in mind that there is a lot that can be done by exchanges themselves that should be done. I mean, we're looking at issues of co-location and whether exchanges, for example, are selling at a high price, extra bandwidth, high-speed switches that create just a little tiny bit of an extra advantage for some traders. This is an area that we have to all look at. Exchanges bear some responsibility. The firms that are using these computers bear responsibility. I'm going to see if anything illegal is being done under New York securities laws, and I'm sure my federal counterparts will be engaged as well.
As I understand it, you're using the Martin Act to bring this investigation.
That's my statute.
Why? Why? It's an awfully powerful instrument.
Well, because I'm the New York State Attorney General and I enforce state law. We have a federalist system, and there are states and state laws, and we have a Securities Act here that predates the federal securities laws. It goes back to the 1920s, and it is broader in some respects than the federal securities law. So I'm taking a very open-minded look at this area, looking for people who are exploiting cracks in the system only for unfair advantage. I don't care if people are buying and selling very quickly.
But what if you're exploiting cracks in the system, but it's legal? I give my kids rules every single day, and they're always looking for cracks to get around them. And if they do, foolish on my part that I let them do it. Are the Morgan Stanleys and the Goldman Sachs of the world who create this Speedway product, are they at fault because they looked for a crack?
No, I think that's a very good point. There are some things here that may be illegal. There are some things that may now be legal that should be illegal or that the markets have to be changed.
So let's change the rules.
So part of what we're doing here, in addition to looking for illegality, is shining a light on this area. And to their credit, the firms that we've really confronted with this, MarketWire, Business Wire, Thomson Reuters, have done the right thing. Everyone has acknowledged that we have problems here that need to be addressed in a more comprehensive way. And I think we have a lot of support in the business community for getting the regulations right in this area, because this poses risk to everyone.
Is there an opportunity here to cooperate, I'm curious, with New Jersey, given that so much of the trading that takes place actually happens on the other side of the Hudson River, these co-location centers where exchanges that are run by exchanges like NASDAQ and the New York Stock Exchange and BATS, for example?
We are in touch with both our federal and state counterparts. I can't really comment much on the details, but yes, we should expect to see other states involved as well.
You mentioned that the Martin Act predates much of federal securities law. Does that create an opportunity for you to enforce these issues in a way that federal securities regulators couldn't, even if they tried?
In some cases.
How so?
We have different standards of proof or scienter, and the Martin Act is a broader anti-fraud statute. It doesn't have the same requirements as the federal statute, but in substance, it's really the same thing we're looking for. We're looking to restore confidence in the markets. We want to make sure that no one is able to front run through some mechanism that no one thought of when rules were drafted 5, 10, or 15 years ago. I mean, the Thomson Reuters deal opened a lot of eyes because most people did not realize that 2 seconds was enough to move the markets. And since they shut that down, the markets aren't moving when they release the Consumer Confidence Survey anymore. We can see a dramatic change from year to year. So I'm looking for cooperation from people in the industry, the exchanges, and from the regulators. We got to get this right.
Are you getting the cooperation?
I mean, so far we're talking to a lot of people, and a lot of people are coming forward with interesting ideas as well.
Do we need to do something different in terms of smart regulation, whether we're talking about HFT or implementing Volcker or Dodd-Frank? It seems that there's roadblocks, and many people say the regulators just aren't armed. They don't have the skill set to regulate these, or the funding to regulate these types of entities.
Look, what's going on in Washington is a fairly opaque process. I wish it was going faster. It's important to have clear rules, and I think everyone accepts that. Even, look, all of my friends and family on the street, if we have a clear set of rules, they'll figure out a way to make money. It's the confusion and
it's the way the market is set up.
Yes, it's right. And I think that we are now dealing with an area of taking a breath and saying the exchanges have traded. The nostalgic view of the old specialists scrawling things on pieces of paper, gone, never coming back. So we have to deal with the realities. And I think that folks in Washington, there are some folks moving faster than others, but I'm looking forward to working with my federal and state counterparts to try and get smart regulation.
All right, I know we have to go, but when we say the nostalgic view of those specialists scribbling papers, isn't it fair to say, well, they had some pretty unfair advantages also?
Oh, sure, but that was where the traditional rules on insider trading, the old regulatory scheme, actually worked pretty well. This stuff is way beyond the old rules of insider trading. That's why we call it insider trading 2.0, because you couldn't use a bit of information about what a market survey says in 2 seconds in the old days. So we have to adjust the rules.
No, but you could control information. You were the only one who knew it.
Sure, but that's why you weren't allowed to trade on it.
Mr.
You're saying some people got away with it? Okay, maybe some people got away with it, but we had a set of laws that worked well for a while. Time to update them.